Let me make sure I get this going right. There we go. Yes, as Matthew said, my name is Paul Andreola with Smallcap Discoveries. And I'm going to apologize. If anybody knows me or watch my videos, you know I love to talk a lot. I've only got 20 minutes, so I'm going to try to go through as fast as I can. Okay, so Smallcap Discoveries, what are we all about? What we've done is we believe we've built a platform that helps uncover some of the most sort of undiscovered companies, microcap companies listed in Canada. Originally, it started off as a blog. I'm an ex-investment banker and spent time as an investment advisor. And when I quit that, I just started blogging about the investments I was personally making. That eventually turned into a newsletter. And now we view the platform really as a community. I see a number of you guys here that are members. And it's a combination of everything from, I'd say, sort of new small retail investors all the way up to family offices, fund managers, a number of sort of institutional type of investors that are looking for the same things we're looking for, right? Early stage microcaps that have the potential to become very big winners. Why we're here, really to show the benefits of what we do at SCD. Elevate the ecosystem. This is something that we really think is important. We feel the ecosystem in Canada in the microcap space is significantly broken for a number of different reasons. And there's a significant effort being put by a number of people in the industry to try to, bring health back to the system and eventually lower the cost of capital for a lot of these small companies. And then really create value. So both for investors in the investment community, but also for the companies that ultimately we hope to be owners of. Why small caps are the best opportunity. I've been at this for almost 40 years now. It's kind of embarrassing to hear me say that. And most of the companies that we come to know as these big winners, these 20, 30, 100 baggers, they typically start very small. We've been fortunate that we've uncovered a handful of companies that have gone up actually literally 100x. And you have to know what to look for. The key to all this too is as investors is, we want to be there before the masses find these companies. And the majority of capital that really ultimately creates the value or the share price comes from institutional capital. So the structural advantage most retail investors have is the ability to literally buy before institutions can physically buy the same stock. In the microcap space, we think we've got a real information edge. We have access to management. We have the ability to interview companies. We have the ability to do site visits where, with larger companies, you don't get the same opportunity. Microcaps, the fundamentals actually have a bigger impact earlier. A company that goes from losing money to making money can have a dramatic impact on shareholder value very quickly. And if you can find that early enough, that's where you can really create value for your portfolio. Math favors small caps. It's easier for a $20 million market cap company to go 10x than it is for a $2 billion company. We've seen that. And then as much as we think the Canadian system is broken, we also think the Canadian marketplace for microcaps is one of the best ecosystems for retail investors. And we've seen that over the course of the last 30, 40 years that I've participated in the market. Okay, so how do we find winners early? We're kind of crazy with this, but we go through every CDR filing in Canada. So if you can understand that there's over 3,000 companies in Canada. They're publicly listed. They file 4 times a year, so there's 12,000 reports that we typically go through trying to find the certain companies that fit the criteria that we look for. That criteria involves a couple simple things, but also is sort of the gateway to a whole bunch of other due diligence. And we look for, at a base level, we want to see companies that are growing by at least 25% a year. And we want to see profitability. For us, we want to see a minimum of 2 quarters of back-to-back profitability. The minute you have a company that turns profitable, the dilution risk is substantially lower. And if you don't understand dilution risk, you really should. That's one of the biggest sort of risks that a microcap investor takes on. You don't want a company that keeps issuing more and more shares and diluting your ownership. And then once we find sort of this shorter list of companies, that's when the real work starts. We do deep due diligence. We do, in a lot of cases, background checks of management. We do site visits. We do interviews. If you follow us, you'll see we've got a YouTube channel. We've done well over 200 interviews at different companies that are publicly listed. Those are available to anybody who wants to check them out. But these are just a small sample of some of the things that we do to really understand what the upside of the business is. Okay, so we use the term price discovery. This is when a company goes from being unknown to being known, and the various sort of stages in between that. This is an example of one of the companies that we profiled early. This company, in the span of about a year and a half, has gone up, almost 20 times in value. And if you see the first arrow there, the company was profitable at that point. So we're able to find companies that, at a profitable stage, at an early point in their sort of stock market discovery life cycle, and there's tremendous upside. We don't have to invest in companies that are losing money because we think we're getting there early. If you get early enough on these companies that are turning profitable, there's tremendous amount of upside. Not only do we get deep mispricing at the bottom, but you also get liquidity changes. So as a company gets more discovered, a couple things happen. One is obviously the price increases, but the liquidity tends to increase along with it. So we hear a lot of people talk about these microcaps that have low liquidity. That tends to change as the company goes up in value, and more people find out about it. And with that, we get what's called expanding multiples. So the PE expansion goes as the price goes higher. You might find a company, a $10, $20 million market cap that's trading at 8 times earnings. That same company, if it grows to 100 million in market cap, likely is trading at 15 or 20 times earnings. Okay, so I really touched on this already. The different stages are really unknown, mispriced. There's some sort of catalyst that kicks in. For us, the catalyst is that 2 quarters of profitability. This is typically still well before the institutions are touching the stock. We can still see a significant amount of upside before stage 3, where institutions are now starting to buy the stock. And at this point, it's not that the stock can't go up in value, but you've lost one of the drivers of value. It's a well-known company, and now you're really, the upside is really based on the fundamental growth of the business. And ultimately, to get the real big returns, you want that undiscovered situation along with fundamentals. Okay, so key takeaways before we get into the sort of next little section. What matters most is you really have to find these companies before institutions do. Most of the major winners start off as microcaps, if not nanocaps in Canada. We believe we've got a system that can help discover these things at a very early stage. We've got a track record of being able to do that. And these are just some of the samples of the companies that we have literally discovered and profiled very early. And I believe pretty well every one of those is up at least 10 times in value over the last 2 years. There's your charts on those companies. You can go back and you'll see that all these companies were either profiled or interviewed at some point over the last 2 years. In some cases, we've known these companies for 10 years before we get involved or get interest in the company. We monitor companies very early, and we're waiting for that inflection point. Okay, so the other thing I want to talk about is really the industry and kind of some of the things that we see broken and how you can take advantage of some of the structural issues around the industry. Charlie Munger has an old saying, or God bless him when he was around, show me the incentive and I will show you the outcome. So this industry is based on incentives. If you are getting your information from brokers and analysts, you have to ask yourself, where is the incentive? Like, what is driving their decisions? In the microcap space, in the nanocap space, a lot of these companies are not talked about because nobody's incentivized to go and tell you about these businesses, right? An analyst is not likely to talk about a $20 million market cap company if they can't go and get fees or some sort of extract some value out of that. So a lot of these great little businesses kind of struggle in obscurity because nobody's got an incentive to go and highlight them. We flip that around. Like, we don't take fees from companies. We are not incentivized by the companies. We're incentivized by us putting dollars into that business and seeing the business be successful. So as a result, good companies stay overlooked structurally the way things are now. Investors miss opportunities because they're having a hard time finding good ideas. And the Canadian small cap ecosystem suffers. We've been talking a lot lately about cost of capital. A lot of Canadian companies struggle in obscurity. Their share price is lower than their US comparables, in some cases international comparables. And that means their cost of capital. If they want to go and make acquisitions, if they want to grow faster, the equity that they would have to issue would be at a substantial discount to their comparables. We want to see if we can help fix that. Okay, so how do we help companies? Well, just that. The membership is about 500 members. And like I said earlier, it runs everything from small retail investors all the way up to very sophisticated institutional investors. And a lot of our members are also industry experts. So we've got everything from doctors, software engineers, you name it, different skill sets that help us in part of our due diligence. We call it crowdsourced due diligence that helps us get a better idea of the upside of a business. We have stable long-term capital because we're not incentivized to be transactional, right? As a broker, as an ex-investment banker, I would love to see an investor put money into a business and then come back to him with another deal a month later and be able to get another fee out of him. So there's a transactional nature to the industry, and we don't need to see that, right? At the end of the day, we're trying to see high returns for ourselves and our members. So what this does is, the sooner a company gets a proper cost of capital or proper valuation, it improves their cost of capital, right? The higher share price allows them now to get more competitive, get out there, make transactions that they wouldn't have otherwise with the cheap stock. Stronger shareholder base. There's sort of an adage in the industry, a company gets the shareholders they deserve. If you're communicating properly, if you are doing the right things, if you have the right capital market strategy, these companies get a better, stronger shareholder base. Stronger shareholder base, lower cost of capital. Financings become easier, cleaner, and significantly less dilutive. Faster discovery. So a company that's going to go through that discovery process I talked about with a stronger shareholder base, especially if they're sophisticated investors that are participants. If I buy a stock, I want to tell somebody else that's likely another sophisticated investor. Share price moves faster, gets to fair value, and that structural difference changes. It shrinks the time it takes to get discovered and get to that point. And then as far as, the industry is a lot of it is based on promotion. In some ways you can say that we promote companies, but we don't charge fees. We don't do anything. Our incentive is we own the business. We want to see the business prosper. So no fees, no pay to play, no middleman. Another benefit of the platform is we get a lot of companies coming to us asking our members if they want to participate in financings. We don't charge fees, so it's cheaper for them to come to us, and we have a stronger shareholder base typically, so there's a better incentive for them to come and give us deal flow. We get to look at a lot of opportunities in the financing space. And it's market-driven discovery. Shareholders become the biggest IR sort of proponent for that business. And like I said, SCD becomes the first call for financings, cross trades, corporate actions, and strategic introductions. How do we invest, or how do we help investors? Well, it's, again, access to earlier insights, earlier opportunities, access to more deals flow. We find those companies much sooner based on that criteria that's been proven over the 30, 40 years I've been doing this. We can see the signals that are showing us that there's institutional discovery starting or that it's yet to start, so we can understand how to participate in the moves in the share price. And it's not unusual for us to find companies that move that 2 to 5x. Matthew talked about the 15, 10 baggers. We have a number of 5 baggers and 6 baggers, and for those that don't know, a bagger means like it's doubled in price and gone up that much. It's not unusual for us. As a matter of fact, I'd say it's almost impossible for us to have identified any of the very major winners that we've seen in the Canadian public markets. Access hard to get information. We have direct insights with a lot of these microcap CEOs. We do regular interviews, update interviews. We have a line of communication that gives us a little bit of an edge. Real Q&A from sophisticated investors. We run at least once a week an interview with a management team, and our members are able to participate live and ask whatever questions they have of the management team. Not a lot of other opportunities where a lot of investors can do that. And then, well, crowdsourced due diligence, I mentioned that. It's really amazing how valuable the skill set and the experience of a lot of our members are to us when we are doing our due diligence. And then one last time, SCD takes no fees. We do not get paid by companies for any of the things that we do for these introductions. We only benefit when investors succeed. We are anti-promotion, no hidden economics, no conflicts. We are trying to find the best opportunities in this space. And I would argue investors get access to the best 20 to 30x potential companies early with better information and much, much less friction. Okay, and the flywheel. The stronger the network, the stronger the outcomes. You know, we invite you, if you're not an SCD member already, we invite you to try us out to understand what we mean by this. We really have some of the best opportunities that are presented to us because of what we've built here. Yeah, we stay away from those sort of incentives that have, we'd say, structurally broken the industry. Every new investor strengthens the flywheel. We believe we elevate great companies. Companies seek us out as a platform. And in our mind, more competitive global capital lowers the structural cost of capital for a lot of these companies. More public companies. We hope that this eventually invites more companies to go public in Canada, which ultimately will give us more opportunities as investors. That's it. I wanted to try to skip through it as fast as I can. I don't know if I have any time left. 9 minutes. I've got 9 minutes. I wanted to make sure there's an opportunity for questions. So, love to answer any questions. Yeah.
Thank you very much, and merci Mathieu Rivemont for cette opportunité for this event. Very rare to find opportunities like this where we can all come together in person and learn from yourself, and to learn what we can offer you as well in terms of membership. When it comes to membership, what qualifies somebody to be a member, and what do you expect from your members in the community?
So it's a paid-for system. So it's $1,000 US per year to become a member. The qualification, it's not really a qualification. The key and where we think you get the most benefit is by participating as much as you can. Be involved in the Q&A sessions. We have a Discord forum that's very active. The more contribution you make, the more you learn, the faster you become almost valuable to the system. So that's the key, is participation becomes really key.
Do you have any companies that you invest in who are part of the fund as well?
So I personally invest?
No, like me as a CEO, could I subscribe to the small?
Absolutely. We have a lot of CEOs that are members. And interesting enough, a lot of the CEOs of the successful companies, having witnessed kind of what the network has done for their shareholder base and their business, we have a lot of those CEOs as investors. Yeah.
We're starting to get a lot more participation from a lot of the CEOs as well, where, we talk about, forming different companies, the different gaps with other businesses, looking for board members. A lot of those other CEOs and these contacts we built up at Smallcap Discoveries are coming into the fold and looking to help us out. So it's like the community is growing and it's getting a lot more dynamic.
And one thing I recognize, like $1,000 for some investors is a significant amount of money. We welcome anybody. If somebody wants to try the service, we have no issue with a free 2 or 3 months opportunity to test it out. We really believe any serious investors will understand the value that this brings, and the majority of the fees that we collect go into the work that we do. We have staff that does a significant amount of due diligence. We're in 2 days, we're off to Europe to meet with a whole bunch of investors across Europe, again, to facilitate a stronger community and a stronger ecosystem for Canadian microcaps. Yes, sir.
Stocks that you're looking at, are they global or are they?
No, we only look at Canadian companies. Yeah, I mean the criteria will apply to any market. As a matter of fact, we've seen a lot of our international members have taken it to their local markets and done very well. The advantage we have is that we can almost operate like institutional investors. Like Matthew knows what, like fundamentally we know what he's looking for, but in some cases he's got structural sort of barriers to where he can go. So what we're trying to do is we're trying to find the companies that, like groups like Matthew and others, are going to buy, but buying 1 or 2 steps before they can, right? But Canada has enough fantastic companies, and you saw the list before, and that's a small subset of the companies that we've been fortunate enough to own. But there's enough in Canada for sure.
I'll ask you one.
Sure.
When you do your daily CDR review, looking at all the filings, you mentioned your criteria of revenue growth, profitability, 2 quarters in a row. I mean, people can screen for that, or even like some people would ask, why don't you use AI to do that? So what is it beyond that, those metrics that you look for when you look at all these filings?
So there's a whole bunch of other stuff. So we like the first couple of criteria. So the 25% revenue growth, profitability, that sort of screens out a whole lot of companies. I probably think that there maybe 5% of the companies that are left are now, I've gone through that screen. We start to look for things like share structure, ownership incentive, like what do the insiders own of the business. Trevor used to be an analyst at the TSX Venture Exchange. We go through all the filings when we start to dig deeper, see how shares were issued, what's their capital market strategy, what kind of options do they issue, all these little factors that, around the edges start to add, add some improvement in the likely outcome. There's no guarantee, but they increase your odds of success a little bit. So it's all these things that are important. There's probably a criteria about 20 when you really look at it. But I will tell you right now, if you looked at really, I'm giving away my secrets a little bit, but there's 3 things if you really look for. If you look for hyper growth, so 25% revenue growth or higher, at least 2 quarters of profitability, and then a stock that's close to hitting a 52-week high. If you guys just look for that, I will guarantee you your performance will be substantially better. But the market is not built to think that way. That's how you can find some of these companies that can go up 10, 20, 50x in some cases, is by looking for those kind of criteria, because ultimately that's what fund managers are looking for.
I agree.
I'll give you a layout that kind of ties into it, but why growth over value in microcaps?
So we see that a lot where investors they look at a balance sheet and they say, hey, this is a company that's trading at like 50 cents on the dollar. That works quite well in the large caps. It works terribly in the microcaps. Microcaps, you need escape velocity. You need companies that are eventually going to get big enough where that institutional capital is going to come and play, and that's going to come from growth stocks. The stronger the growth with profitability, the more likely it's going to become an institutional darling. And the stocks I'd mentioned before, Kraken and Kits and Gatekeeper and Zoomed and Zedcore, these are all companies that they were sub 20 million market cap at some point, right? Institutions could not buy these things. And now they're all institutionally owned, right? And Kraken, for example, I think it's $2 billion market cap company now. These were nano caps at one point. And that's what we're looking for, is we're looking for the next ones. And they all have the same common denominator. It's not that hard, but you have to put in the work. Like we go through 12,000 filings a year. Yeah. Anybody else? Did I do okay, Matthew?
One last question.
Yes.
How do you define your niche, you're targeting to analyze?
Well,
from these companies, we mentioned like 3,000 companies.
Yeah.
what filter that would help?
So the first one is, I'm going to go back to it. It's that 25% revenue growth.
What I mean, like in terms of market caps, like that.
Okay, well, it's weird, but they will sort of self screen themselves. So we tend to find most of the opportunities sub 100 million market cap. The institutional players really start to pay attention around once you get to about $100 million market cap. So I was very fortunate years ago to buy a company called Expel when it had an $8 million market cap. It's a $2.5 billion market cap now. Had I waited until it was $200 million market cap, I would have lost a lot of the upside. These companies are out there on a regular basis. They don't come to you. That's the thing, is you have to go find them. It's very rare. There's no incentive. They're not going to hire a promoter because these companies are profitable. They don't, in the short term, they don't care what their share price is doing. You have to have a system to go and find these things. Yeah. Yes. So okay, so there's a book. If you haven't read this book, you got to read it. It's called How to Make Money in Stocks by William O'Neill. It changed my financial life. To understand, if a company is going to go up 100 times in value, it's going to hit a 52-week high a whole bunch of the ways all the way up there, right? It will change your mind in terms of how to think as an investor. We've been kind of taught in a lazy way to buy low, sell high, right? The reality in the microcap space is you want to buy high and sell a lot higher, right? So if you're going to buy Amazon when it's hitting its 52-week high, the first time it hits 52-week high, you're going to catch it way before anybody knows what Amazon is, right? It's a weird little dynamic that you have to understand. And the same thing too is if you're going to get a stock that's going to go up 100 times in value, you have to have the resiliency or the strength to hold on to it as it's going up. It's hard to hold on to a stock that's gone up 200, 300, 500% because you think it's going to top out. You have to have that psychology to be able to say, no, it's hitting a 52 guy. It's not scaring me, right? So it's the 52 guy, I'm telling you, in the microcap space, in growth stocks, is extremely important to get to understand that dynamic. Oh, there you go. Okay. Thank you, everyone. Thank you.